love the channel and find it useful in becoming a happy retiree. Subscribe today. Now, so we've got a lot of momentum, just not only from the consumer, but small business optimism as well. What about retail sales? Well, a little bit softer most recently, but still intact is the consumer. Hey, listen, a confident consumer is still the workhorse of this economy. And remember, we're just starting to see the impact of those tax cuts. The tax reform started. We know that for 2018, this is the first year of this new tax bill. We're going to see about $120 billion come back to the consumer that our consumers you and I would have otherwise not had in our pocket due to slightly lower tax rates and slightly higher standard deduction that impacts, call it 90+% of Americans. You'll see more money in your wallet after taxes than you would have under the old tax system. That doesn't all happen at once, so you don't see this giant run up in gross domestic product. You'll see it over the course as the year plays out in 2018. So the consumer is strong. The business environment is fertile as well. Let's move to housing. Housing, Commerce Department on Friday, very recently, housing starts see at a pace of about 1.2 million of new houses going up. Remember back in 2009, and again we had a housing bubble, so we were overbuilding. We were building housing starts were at a pace of about 2 million, which was just quite frankly too many new houses. So we created too much inventory. That virtually stopped. We had a period of time where housing starts dropped all the way to around the 400,000 level. It went from 2 million at an annual pace all the way down to 400,000. And if you look at a chart of that housing starts, which I think is a really important economic indicator to look at, it has steadily risen throughout this economic recovery. And it continues to do so. And so the chart is higher and higher. And here we are in about a 1.2 million range. So far, far better than where we were in 09 and 10 as housing starts and builders have the confidence to say, okay, look, we still have a housing shortage to some extent. I'm going to take the economic risk to go buy land, develop land, and build houses. So housing is absolutely intact. Let's move to interest rates and inflation. We still have an environment where interest rates are still low, even though the Federal Reserve has pulled rates higher and higher and higher. Historically, they're still really low. We have a 10-year Treasury it's still under 3%. What's normal, quote normal, call it 4.5%. So we still have a long way to go. We're still lower than normal with interest rates, and inflation is still in check. We do have to watch inflation though. As soon as wage inflation gets to the 4 to 4.5% level, that's when we've seen historically, that's the kind of economic variable. I call that the black widow of economic variables. If we see that get into the 4 to 4.5% range, again, this is wage inflation, that's when we typically start to see a recession on the horizon. And we're just not there yet, which is good news. We're really more like 2.5% on wage inflation, and we still have a long way to go to get to that 4% level. So I'm fine with inflation and I'm fine with interest rates, both in a healthy spot for the U.S. economy. If we go to manufacturing, kind of the next piece in Chime, manufacturing is at the levels here. If you look at manufacturing data, we want to see manufacturing, those readings be over 50% or 50. If we're above 50, that means we're still in expansion mode. That's exactly where we are today. We're at 55. That means that manufacturing is still expanding from the base it was the month prior in the United States. Now, how about earnings on the E part of CHIME? How about earnings and employment? Employment in general continues to be very solid. The last print, 300+ new jobs. We're going to get another new job number coming this week. But the last time we got the jobs number, we saw construction. We saw 61,000 new construction jobs last month. The unemployment rate, 4.1%. You talk to economists, that is arguably almost full employment in America. The labor force participation rate went up to 63%. We've seen that. So that's, people are saying, hey, I'm going to go back into the job market. The job market's getting good enough that it's pulling people effectively who say, look, I don't even want to go look for a job, to say, hey, it looks like I could probably go find something now. So people are coming off the bench, if you will, back into the game of looking for a new job. That's a big jump, up to 63%. And again, wage growth when it comes to earnings, or when it comes to employment, still kind of in check in that 2.6% range. Bottom line, right now, there are still no signs of a slowdown for the U.S. economy, at least for now. This means that earnings for companies here in the U.S., they've got a tailwind. So what we invest for in equity markets, that fundamentally has a tailwind, which is a good thing. The economic backdrop over the last 9 years hasn't been without bumps post the great financial crisis. You and I both know that. But for now, the cycle that we're in still showing signs of strength, still showing signs of expansion, and that bodes well for continued earnings growth, profits growth for markets. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.